Hello everyone, welcome back. In today's video, we're going to talk about these three groups right here. Business owners, stock market, traders and investors, and real estate investors. And the reason why we're going to talk about these groups is because if you think about it, anybody who were able to create wealth, to truly become wealthy in their life, did it through any of these three groups or all of them together. Now, notice here that I did not include any W-2 earner, basically an employee. And the reason why I did not do that is because, to my knowledge at least, I don't know any employee that became rich by working for somebody else. Now, yes, I know some people are gonna say there are these rare exceptions where an employee being a CEO or maybe an employee number one or number two were able to become rich. But in that case, I think that they did so by, first of all, working very long years for the company, managing their money very well. And I will say, I could argue that at that point, being that high level of an employee, you're basically a business owner at that point. And also in these high levels, they tend to give you stocks. So you're also not only a business owner in the company, but you're also an investor in that same company. Okay, so now that we put that aside, let's focus on these three groups here: business owners, stock market traders and investors, and real estate investors. Now, when you first look at these three groups, you may think that they are different, but in fact, at the very fundamental level, they are very similar. And why is that? Well, they basically all do the same thing. They all focus on two activities: buying and selling. They all buy and sell. And that takes us back to the old saying, buy low, sell high. Now, if we talk about buying low and selling high, we are inadvertently talking about a price component in that statement. We are automatically talking about price at that point. And so for that reason, I included price here. But what really affects price? Two things: quality, in this case, not quality of the asset, but quality of the opportunity. And I will explain myself in a little further note. Quality of the opportunity and also time. So let's talk a little bit more about this concept here. If we focus on this side of the chart, we have business owners and traders. They are very similar in a way that, say for example, a business owner. Say somebody who buys and sells items in Amazon, for example. That person is able to select a market, select a product that they want to buy and then sell. If you think about it, they are able to select the price at which they want to buy that asset or that product, and then which price at which they think their market will be willing to buy that product for. So in a way, they are able to set the price, the entry price and the exit price before they even engage with the market itself. The traders, they do the same thing, except that they are not able to choose their price. They're not able to, well, yes, they can choose the price at which they enter a transaction, but they are not able to have any say on what the market thinks the price is at any specific point. If you think about it, they both are trying to sort of like play with the price. Let's explain this forward. For example, or further. For example, let's say you have a trader or a stock market investor, somebody who purchases stock, and now the stock have gone down in price, and now they're sitting there with their portfolio basically in red and all the stocks that are now being valued at a lower price. They're not able to sell that stock at the price that they wish to sell it for. It's basically the same thing when you have a business owner who is having inventory sitting in their garage. They bought that inventory, but they are not able to sell that inventory at the price they wish to sell it for. It's the same thing. One is having inventory in their brokerage account and the other one is having inventory in their garage. They both bought at a certain price. They both now are not able to sell it to the market at the price they wish for. Another comparison might be, for example, sometimes you see traders that are trading and they are talking to the screen and they're saying, go up, go up, go high, so they can sell and they can realize a profit. In a way, this seems a little bit funny, at least to me, because, well, first of all, they're just talking to a screen and the market is not really listening to them. But they sort of like want to hustle in a way. It's the same thing as a business owner who is trying to make those calls, who's trying to sell their product. Although a business owner in this case, you may think that might have more control because all they have to do is just convince the other party to buy their product versus the trader who is trying to convince the market by just talking to the screen. But in a way, I see that the trader is trying to hustle with the market in order to be able to sell the stock. So again, you can draw so many comparisons, but what I want you to understand is that a business owner and a trader, they're trying to basically do the same thing. And their success depends on the quality of the opportunity they choose. In other words, they always have to find, or their goal is to find that opportunity where they can buy low and sell high. They are always looking for those opportunities where they are buying low and selling high. So their success depends on the quality. The quality of the opportunity influences the price, okay? So now let's focus on this side of the chart. We have real estate investors and stock market investors. And in this case, they're also trying to buy low and sell high. But instead of focusing on the price in the short term, they are not paying attention to the price. They are letting time do the work for them. Again, here, time is what influences the price at which they can sell their assets. So it's like every time I'm explaining the stock market to a real estate investor, or if I'm explaining somebody who is involved in the stock market, but that have that long-term view of the stock market, if I'm explaining real estate to them, it's like immediately click because they really have the same mindset. Real estate investors, they have a long-term view of their investments. They are patient. And also people who tend to invest in the stock market. And they are not looking to speculate. They just want to buy something and let it sit and let it grow. So at some point they can sell the asset and realize a profit. They are also patient. They are also just willing to sit in their asset and just let them grow. So in that sense, you will see that stock market investors and real estate investors, those who have the long-term horizon view of their investments, they tend to be very patient and they tend to have the same mindset with respect to their investments. But in a nutshell, they are trying to do the same thing. They're trying to buy low and sell high. They're trying to find a price at which they can realize a profit, but that price is influenced pretty much solely at that point by just time, not quality of their opportunity. Okay, so now that we understand how all of these groups are in a way similar to each other. And the reason why I'm bringing this concept to you is because you might be familiar with any of these three groups, right? And sometimes you are trying to understand a new area of the economy or a new concept altogether. Well, by drawing comparisons to that new concept based on the knowledge that you already have, you might be able to understand the new concept in a much faster way, or sometimes even look at something that is completely new to you from a fresh perspective if you base it on the knowledge that you already have. And specifically, the reason why I'm telling you this is because for all of you real estate investors who are out there, you know that most of the time you're not just buying a property and waiting until it appreciates in time to sell it. Yes, that is a way to generate money. But most of the time you are buying real estate because you want to do it for a rental income. You want to buy something, put it out for rent, and if it appreciates, great. If not, it's okay. But you just want to generate that income from it every month. Well, in the stock market, there is something very similar that I found that if you think about it, is almost as turning stocks into property. It's basically as receiving rental income from the stocks that you have. And that specific instrument is a financial contract called covered calls. And it's something that I have already previously talked on this channel, but I will continue building on this knowledge because I think that is so remarkable, so powerful, that we oftentimes are investing in the stock market and we are just having one mindset of just let it sit and wait until it appreciates in time. Whether during all the time we could also generate income in another way. Again, that way that I wanna talk to you more about in future videos is called cover calls. You can go back to another video that I have already made on financial contracts. I can link that video to the end of this video. But in order to not make this too long, I will just leave it here. But I want to let you know that there is a way to also make money, constant cash flow in the stock market while also waiting for your stocks to appreciate in value. All right, so that's it for today's video. I will see you in the next one. Thank you.